Hi, this is Leo Kelly, and this is the Kelly Wealth Management Quarterly Review for the third quarter 2016. Thank you very much for being here and listening to our views on the marketplace. We thought we'd start the quarterly review this quarter with the economy. 2016 has continued to move along, very similar to the several years before it. We have slow, steady growth here in the U.S. economy, growing somewhere around 2%. And again, this is causing a lot of angst in the marketplace. Obviously, we'd all like to see faster growth, 3, 4, 5%, but 2% is slow and it's steady. And as we've said for many years now, steady growth is sustainable growth. When we don't grow too fast, then we don't get imbalances in the marketplace. So the big question on everybody's mind is this slow growth something that's turning into a recession, or is this a steady, sustainable pattern? And as we look at the first chart for our quarterly review, what we see is real GDP continues to move along at this pace below norm, below average. As we look at the chart and you see prior recoveries and prior growth rates, you see much, much higher numbers than what we're currently going through. So again, this is showing this continued pattern of just consistent, slow, stable growth, and that's moving into 2017. So the big question is why? Why is this happening? And on the next chart, you'll see here are growth components, and that's growth in workers as well as growth in output per worker. And so we have two factors that are causing this slow, stable growth. One is that we have less workers who are less productive, and that's turning into, again, a slower pattern. And if we look at the next chart, we'll see that one of the reasons we have less workers is that there's less people looking for work. So this is one of the main confusions in the economy right now. We have people out there who are looking at the marketplace and saying, well, wait a minute, we have 5% unemployment, that's full employment. Every single employment report, we're hearing about new workers coming in, and obviously the political pundits are all touting how good the employment picture is. But as we'll see on the chart, since 2002, the participation rate of employees continues to fall. So while the numbers may look good, the reality is there's less people working. 5% of a lower number is still less workers, and that's part of the issue with the slow growth in the economy. Now, consumer sentiment is continuing to remain okay. The next chart shows the consumer sentiment index, and what we'll see is that we are above the average break-even rate for economic stability, and yet we're not up at the higher numbers when we get a real frothy economy. Now, what's important about this chart, when you hear about this on news channels, you hear, well, consumer sentiment is up or down. You have to remember, this tends to be a counterintuitive index, meaning when the consumer sentiment is very high, the market tends to be a bit frothy, and that tends to be before we see a pullback. The reverse is also true. When consumer sentiment is very low, they tend to be a trailing indicator. Something has already happened, the market's down, and they lose confidence. So as we look at the chart, you'll see November 2008, August 2011, both terrible times in the marketplace. Consumer sentiment low, market rallied significantly. January 2000, 2004, and January 2007, higher consumer sentiment numbers just before market decline. So where are we today? Right about average. It fits in with the overall message of the economy and the market. Average, slow, steady, chugging along. Moving to the markets, the stock market in 2016 seems to be finally moving out of a pattern from 2014 and 2015 that was really problematic for investors. 14 and 15 were extraordinarily narrow markets where a small group of stocks were driving the returns of the S&P 500, while broadly stocks underneath that higher market cap range actually struggled quite a bit. Specifically in 2015, we saw the top 10 market capitalization stocks of the S&P 500 up approximately 15%, while the other 490 stocks in the S&P had an average loss of 5%. And so we have two different markets. Now, overall, the S&P was up a little over 1%. Investors said, well, that's not so bad, a slightly positive gain. Yet there were so many stocks that were actually had their own bear markets in 2015. Actually, that market reminds us quite a bit of the 1998-99 market going into 2000s when we had the tech boom and then bust. This next chart is a chart of the markets from 1998 through 1999. And what you'll see is the top white line is the S&P 500. Now, the S&P 500 is actually market cap weighted, so these large market capitalizations have a big impact on return. The green line is the S&P 500 equal weighted. It takes out the impact of the extraordinarily large benefit that the S&P gains from large market capitalization stocks and equal weights the whole 500. And as we can see, in 1998 and 99, the similar pattern occurred where the S&P 500 had significantly higher returns than the equal weight. These are the same stocks. It's just how you weight it. Now, going forward, these trends that are anomalies in the market tend to fix themselves. So as we look at 2000 through 2006, this reverses. The tech bubble bursts, small cap stocks, REITs, value stocks all come back into favor, and the market flips over. And so from 2000 to 2006, on the next chart, you'll see that the equal weighted index significantly outperformed the S&P 500. Why is this important? It's important because right now we are seeing several statistical anomalies in the market that are very similar to that market. Growth stocks, 2 standard deviations higher in valuation than value. Non-dividend payers, significantly higher than dividend payers in 15 and 14. We're seeing a big call for passive investing. Just put it in the S&P, it'll outperform. And yet, what history shows us is when we reach these points of high statistical anomalies, the reversal actually can be quite exaggerated, as we see in 2000 through 2006. So again, as we always say, put capital where capital is scarce, put capital that is in sectors that are out of favor. That's how you make money in the long term. In terms of global growth, we are continuing to see the same basic pattern. We're seeing growth, we're seeing expansion in economies around the world. As you can see, United States in the next chart shows stable, steady growth. The euro area has come out of its recession, continues to grow at a slow pattern, going to grow slightly higher in the coming year. Japan is going through tremendous turmoil. Negative interest rates in Japan. That's actually quite shocking. I wish I could tell you how that one ends up, but nobody has ever seen this in history. So this is going to be something to watch and watch very carefully. Emerging markets. Emerging markets actually were one of the best markets in the marketplace this year in 2016. Again, as commodity prices stabilize and slightly rise, as the world economy starts to slowly grow, that's a big benefit for emerging markets. Still a lot of risk there, but obviously starting to show some benefits. Even Russia has rallied as oil prices stabilize. So across the world, we're seeing markets growing, continuing to grow at a stable pattern. China, obviously, if we look back at the beginning of 2016, everyone was worried about China. Everybody was convinced that China was going to crash. And here we are about 3/4 into the year, and China's continuing to grow at a very similar pattern that it has in the past. You may remember back to some of our earlier quarterly commentaries. We talked about China. When there's panic in the market, it's a time for calm. It's a time to think through the logics of what's happening in the marketplace. And in this case, China, the story there turned out not to be nearly as severe as people had thought because they started to de-link their currency from the dollar. One of the biggest issues right now, and one of the reasons we're seeing this global growth at such a slow pattern, is because there's so much money in the world. We have all this money sloshing around in the marketplace, and the problem is the money isn't moving. The next chart is a very interesting chart. The blue line actually shows the Federal Reserve balance sheets. Now, we talk about this all the time. In this particular case, you can see that the Federal Reserve balance sheets have exploded since 2007, and they've blown up to over trillions of dollars around the world. Now, the red line is the velocity of money. The velocity of money is simply the money goes into the system and it rolls through the system and turns out. Banks take money, they lend more than they actually bring in. That means you've got more velocity of money. Now, what's interesting is the opposite effect of what everybody thought would happen has occurred over the last several years. As the Fed poured more and more money into the system, the velocity of money turned down. What does that mean? It means the banks took the money, they held on to it, they haven't been lending aggressively. That money's finding its way into the markets, it's finding its way into securities. Where it's not finding its way is into the economy. It's not finding its way into investing, capital expansion, and therefore you get slow growth in the economy. Now, all that money is a nice background to protect the marketplace and hold up asset prices. So this is really an important factor in the marketplace. We need to continue to watch the velocity of money. It's starting to turn up a little bit. That's good news for capital expansion, but it's still quite low, despite the fact that there's so much in the marketplace. Now, as we look at the market itself, what we also have to realize is how far we've come. And so in this particular expansion from 2009, the bottom in 2009, you'll see that the market is up about 220%. This is actually one of the better expansions that we've ever seen. As you look back from 2002 to 2007, 100%. From 1996 to 2000, about 106%, and we're up 220. This is amazing because this is clearly the most hated bull market in history. Again, the most hated bull market in history. Throughout this entire process, because the 2008 disaster was so bad, everybody has hated this bull market. Everybody's doubted this bull market, and yet here it continues to grow. Slow, steady, lacking in balance. So this is important. What's also important to remember is we get 2 bear markets a decade. That's 2 a decade. Now, one could argue we had a hidden bear market in 15. We haven't had an official bear market. We're almost done 2016. What's important to remember is the market can turn on factors that we don't know exist today. What's even more important is when this occurs, stable, steady, consistent investing is the message. And I want everybody just for a moment, as you look at this chart, think back to March of 2009. Think back to the S&P 500 at 660 and what your mentality is, what you were thinking. The world was telling you that the whole system was crashing down and there was no way you can make money. We heard we lost a generation of investors. We heard you'll never go back to where it was. We heard it would take a decade to make money. And here we are about 7 years later, and the market is up 220% fully recovered. When you hear the commercials on TV about different assets and don't put your money in the stock market because you'll just lose it, remember, the markets go down, but if you invest during pockets of underpricing, you can actually do quite well. So we continue to send the message to look at valuations and invest where there's appropriately low valuations and good risk-adjusted return. One of those areas that we've been talking about now for about a year is oil. And as we can see in the next chart, oil pricing is actually stabilizing. And interestingly, I'm starting to see reports where people are saying, wow, we think oil's going higher. Oil today is approximately $50. We've come off of a $26 low. Again, at $26, we heard all the pundits say oil was going to continue to go down, and we weren't going to see $50 for a long, long time. The market in a big run high or a big run low will always talk in absolutes, and that tends not to be the case. And so here we see that oil is actually starting to stabilize. Now, one of the reasons in the top left chart, you'll see that oil crude inventories and rig counts are actually starting to decline. This makes sense. Oil is probably one of the most price-efficient assets in the world. When the price gets too high, people start buying small cars, they use less, and therefore demand goes down. And when the price is high, all the producers run out and try to pull as much oil out of the ground as they possibly can while they can make a lot of money. This drives costs down. When it gets down, it becomes cheap. People buy big SUVs again. Right now, the car makers can't make enough SUVs. And of course, what happens? The chart shows you rig counts for shale oil production in the United States collapse. They can't make money. they stop producing and they start to cut back on supply. And this, of course, pushes oil back up again. So again, we never want to talk about oil in absolute prices. And the bottom chart actually shows you the oil never really stays in one place. Back in 2008, it was $135, and by the end of the year, it was at 43. And at 145, they talked about China's going to change the world and oil will never go back below 100. And at 43, it's never going to go back above 100. And of course, it went back above 100 and then to 26. So when it comes to these commodity prices, remember, nothing is absolute and nothing is forever. And we have to make sure that we understand what's happening. Now, again, when we look back at the beginning of 2016, and this has been a good market this year, and a broad advanced market this year, what were the three concerns? We talked about China, we talked about oil, and the other was spreads. What do I mean by spreads? Yield spreads. This is a measure of risk in the bond and credit markets of corporate America. And so one of the big concerns was that when spreads go up, that means the market is demanding a higher interest rate for debt, and that means there's more risk. So if the market's saying, I'm afraid you have to pay me more to own the bond, that means spreads are rising. When the market is less concerned that they don't need as much money, then those spreads go down. And as we'll see on the next chart, at the end of 2015 and early 2016, we started to see spreads rise. And as spreads rise, the market became more and more concerned. The market bottomed out on February 11th of 2016 for the year. And what happened? Oil was at $26. China was a big concern. Spreads were rising. Now, again, this is a time where you have to look at this pragmatically and take a step back away. Why were spreads rising? Well, if you actually broke down the debt market more specifically, you would see that it was energy spreads that were rising, and anything that has to do with energy, like industrials that earn a lot of money from the oil companies. And so these spreads started to rise, and as you can see by the chart, throughout the year, they've continued to come down steadily. And now here we are with a market that's advancing. So what were the three big problems in February when everybody was convinced we were going into a big bear market? It was China, it was oil, it was spreads. And as we can see, those have all settled down and the market has advanced accordingly. Now, one of the big issues we still have is historically low yields. So as we'll see on the next page, as we look at where to put money, investors are having a difficult time. 2015 was statistically one of the hardest years to make money in 75 years. Now, when I say that, sometimes clients will say to me, Leo, there wasn't a big bear market. 2008 was much harder, but that was for stocks specifically. The difference is when the stock market crashes, there's somewhere else to make money, government bonds or gold, or maybe it's another asset. Last year, all the assets were down. Nothing made money. Everything was flat. And so where do you put money? And so as we look at the market today in the fixed income market, it becomes more and more difficult as these bond yields go down. And internationally, they go negative. It becomes more and more of a problem. And in fact, one of the reasons why we think stocks are doing so well, as you'll see on the next chart, is that the S&P 500 dividend is actually higher than a government bond. And so here we are faced with the question, do I want a bond that is guaranteed to have no growth? Put $1,000 in, wait 10 years, get $1,000 out, and collect a little bit of income? Or do I want to own a stock that actually gives you more income and has the ability to grow? The answer is investors are voting for the S&P 500 right now. Emerging markets are doing quite well this year. We talked about that. They've had a big run. They've actually outperformed developed markets significantly. But as the chart here will show, they're still less expensive. Now, one of the reasons is there's more risk and there's more volatility. But as we look at this, the forward PEs on the emerging markets are still significantly less than developed markets, a 17 versus a 13. And yet, growth rates are still very strong. So in the emerging markets, a quick message here. We're looking at them. They look interesting to us. If commodities stabilize and if the economies continue to grow on a stable basis, emerging markets have been beaten down for so long that looks opportunistic to us. However, it's important to note those are the most volatile assets with the most risk, and caution is definitely warranted here. Back to the historically low yields. The next chart shows us really an interesting message in terms of investing. When markets, stock markets specifically, go through turmoil, people run to government bonds. And the reason they're safe and they offer income. Well, I would submit to you today, anyone who's owning a 10-year government bond is safely losing money every day. And this chart shows the difference between a yield that's nominal, the actual dollars you take, and a yield that's real, which is the dollars you bring in minus the inflation, the cost of everything going higher. And as we'll see on the chart, nominal yields today, as of the end of the quarter, are 1.6% on a 10-year, but inflation's 2.3%, which means the cost of everything you buy is going up 0.7% faster than the money you're taking in. Losing money safely every day. This does not happen often, if ever, and so this is an interesting time. And as we can see, even when you go back to September 30th of 1981 on this chart, when interest rates were 15.84%, we still had negative real yields at that time because inflation was growing dramatically. So it is important to note that inflation plays a big factor in the end outcome. And as we can see, this is one of the great bull markets in history, is the bond market, as yields have gone from 15% down to 1%. Yields go down, prices go up. Now, what's important here is if I turn the chart over, that means prices are up, and they're up a lot. Again, caution is warranted. We have a negative real yield and very high prices. We mentioned negative rates. This is really a fascinating chart and speaks to the day and speaks to the overwhelming amount of money in the system. This is global debt, and what this shows is interest rates. And what you'll see is the percentage of issuance that's in positive versus negative yielding returns. Before 2014, this chart basically was all blue. There was no reason to show this chart. Now suddenly, negative yields. Take a step back for a second. Let's make sure we're clear on what that means. You give the government your money and you pay them to hold it. It's absolutely extraordinary and the effects are still not felt. But as we can see, this is becoming more and more of a trend as actually negative yielding yields are continuing to climb. The impact is going to be companies in those countries are going to want to get capital out of those countries and move out to other places. What the governments are trying to do is stimulate activity. You're trying to force the banks to lend, force people to spend that money. In other words, if I got to pay for you to hold it, maybe I'll go find a better use for it. Jury's still out whether that's going to work. Alternative investment portfolios. Right now, alternative investments, which we defined as assets that are not correlated to traditional markets, like equities or bonds, alternative investments are under fire. The returns have been a little bit low. They tend to do well when markets are volatile. They tend to do well when credit spreads are wider, and they tend to do well when you have a little bit of turmoil. And that's why they are useful. They are non-correlated. So when other assets are going through stressful times, we hope those alternatives offer us diversification in the portfolio. And this is an interesting chart. The next chart shows basically the 30-year yield and the S&P 500. And so what we see is since 1979, the S&P 500 has gone up tremendously, and the 30-year yield has gone down significantly. We just mentioned that. So we have equities at tremendous highs, we have yields at tremendous lows, and the question is, do we want to put all our money in one or the other, or do we need diversification in the portfolio in an asset maybe that is something different than what we're looking at? Well, the next chart shows 60-40 balances and basically how high or low they are relative to the market, and should we be diversifying? So on this chart, we'll see in 1997, the 60-40 went 2 standard deviations high. And by 2003, the market bottom, it came back down. It goes back and forth and back and forth. And again, we hit this 2 standard deviation high in 2015. What does all this mean? It means that when these portfolios get to 1 and 2 standard deviations, it happens very rarely, but that tends to be a peak of passive investing. Now, when was the best time to have hedged assets? Well, it was in the bear market of 2000 through 2002, 2003. It was in 2008 when the market crashed. And as you can see, at those 2 points on the chart, we're at a 2 standard deviation low. So when do you buy these alternative investments? The answer is you buy them when they're out of favor, and they're out of favor when this chart is at the top. And as you can see, we're close to that top. This, again, is always the way the market works. At a point where everybody becomes frustrated with an asset and they run away from it is quite often the very best time to be investing in that asset. And interestingly, as we look at returns, one of our favorite areas in the marketplace is actually private equity. So private equity is not in the public markets, and therefore they're not liquid. This is not for everybody. There's long lead times on these investments, but for that illiquidity, we want higher returns. And the next chart shows that actually these private equity investments have delivered those returns. So as we can see, the MSCI ACWI, that's an all-world index. That's basically looking at all the stocks around the world, and you'll see the returns over the last 5, 10, 15, and 20 years have been somewhere around 5–6%. Not great, but that includes one of the worst decades in history, which was 2000 through 2010. Now let's look at the private equity. So buyout and growth equity index returns, private equity returns, 11, 10, 12, 13. We are getting an equity premium in private equity. Now there's a big push away from illiquidity, partially because of the crash in 2008, 2009. Assets went down significantly. People reached out for liquidity. The private equity was locked up. And so there's been this push away from illiquidity. But again, I stress the point, illiquidity gives us the ability to make a higher rate of return, provided, of course, that we do our homework, do the due diligence, and find the right managers who are in the right areas of the market. And last but not least, and I get this question from clients constantly, what's going to happen with this election? And again, I'm not going to give a political view. Whether you're a Republican or a Democrat or a Trumpian, whatever you are, we're not going to comment on what's the right call. But I want to stress the point, we're not electing an emperor. We're electing a president. And a president is there to lead the country. And by all measurements, this is without question one of the most contentious presidential elections in history, and one with the strongest opinions on one side of the fence or the other. But I want to take a step back because everyone who's on the one side, say the Trump side, thinks if Hillary gets in, the markets are going to come under extreme stress because of all the problems that are going to occur. And everybody who's pro-Hillary thinks if Trump gets in, the markets are going to go crazy because of all of what he's going to do. And at the end of the day, let's take a step back and look at this in a more pragmatic fashion. Candidates tend to run and politic on extremes and then govern more moderate. And again, these aren't emperors. So we have a Congress and we have a Supreme Court, and we can debate whether that's going to be effective long term. And these are issues that are more political than they're market oriented. The message here is pretty simple. Why Saturday Night Live is entertaining us through this whole process, and the actual reality is somewhat less entertaining and more disconcerting. I think the reality is, from a market standpoint, take a step back and understand this is like every other presidential election. What really drives the marketplace is profits, it's business, it's the economy. Do these people have an impact? Yes, they can kind of steer it in a direction, but they're not going to take the market down or make the market explode either way. So with that, we'll leave the disclaimer up so you can read all about it. And I'd like to say thank you very much for the time spent here with us. Again, if you have any questions, we're here. Please feel free to contact us, and we'll look forward to speaking with you on the fourth quarter review. Thank you very much.